Welcome, folks. We'll be covering Amazon earnings coming out not too long here, just after the bell, as well as live streaming the conference call. Amazon's earnings are expected to be released just after the bell with EPS of 82 cents and revenue of 142.57 billion. So stay tuned. Pretty uneventful day overall in the markets. We're just kind of hanging around this key level of support, just around 50.90 on ES. We've been heading lower after we broke below that key level of options positioning, which was around 5100 SPX. And as we got sort of unglued from that sticky area of gamma exposure, we saw pressure prevail. We also had earnings, the employment compensation index really showing higher growth than what the Fed would want to see. We had some PMI data that wasn't too ideal, but I think overall we just keep getting signs that there are residual areas where inflation is set to remain sticky. And that tells us that the path of least of resistance for rates on the long end is higher. And that's starting to become a problem for equity, as I was talking about, really 4.5% on the 10-year being a concern. And we're well above that now.
MSOS, cannabis ETF hitting new highs, up 25%. Michael Sandy, Oscar Sandy.
Market on close imbalance, 2.2 billion to the sell side.
And so it brings us now 10 minutes away to the cash equity close, after which we do get Amazon reporting Q1 2024 earnings. Estimated EPS of 82 cents and an estimated revenue of $142.59 billion. After this, keep in mind we're also expecting earnings from Starbucks and AMD following the close as well.
LEXX, like Seriet, to receive $4.7 million in gross proceeds in warrant exercises and issuance. That's Lima Echo X-Ray X-Ray.
Iceberg ESM for CME buy at 50.85 crossed 500.
Head of the cash equity close here, the S&P 500 is just extending declines. It's now down around 1.3%.
Coming up after the close at 4:01 p.m., Amazon AMZN. At 4:05, SMCI Super Micro. SBUX Starbucks MDLZ Mondelez. Just after that, PINS Pinterest. At 4:15, AMD Advanced Micro Devices PRU Prudential, CLX Clorox. ACB Aurora Cannabis getting another pop here, $9.16, up 44%. Alpha Charlie Bravo.
ES Iceberg alert. Buy 1022. Iceberg ESM for CME buy at 5079.5 crossed 500. ES stop alert.
So in 5 minutes
Sell
time now at the
1003.
cash equity close, we expect Amazon to report their Q1 2024 earnings, estimated EPS of 82 cents, estimated revenue of $142.59 billion. In around 10 minutes time, we expect Starbucks to print their Q1 earnings as well, estimated EPS of 80 cents, and a revenue estimate of $9.13 billion.
S&P 500 futures right now 50.7450, down 73.
One minute remaining to expecting Amazon's Q1 earnings. Again, an estimated EPS is 82 cents. Estimated revenue is $142.59 billion. Just under a minute now.
Thirty seconds to the U.S. market close.
Iceberg ESM for CME buy at 5,066.25 cross
Caesars
500.
is
Still
out.
waiting on
Iceberg
Amazon
ESM
earnings.
for CME buy at 5,065.5 cross 500. Iceberg ESM for CME buy at 5065 cross 500.
Revenue of $2.74 billion. The estimate was $2.87 billion, so that's short for Caesars. Charlie Zulu Romeo.
As I
Coming up,
say,
Amazon.
no Amazon earnings coming through
Amazon
yet.
is out now.
Still waiting,
Amazon
coming through
reporting.
now. EPS coming in 98 cents. That's a beat on estimates of 83 cents. Net
Sales
sales is a
of
beat, $143.31 billion
The estimate was
on estimates of $142.59 billion. Amazon Web Service next net sales ex FX.
Quarterly
They're up
AWS segment
17%,
sales
which
increased
is a beat on estimates of
17%.
14.5%. Operating income is a beat, $15.31 billion on estimates
Earnings
of
of
$10.95
98
billion.
cents for Amazon.
Amazon
The
Web
estimate was
Service net
78
sales,
cents.
they're a beat at $25.04 billion
for
on
Amazon.
estimates of $24.11 billion. Operating
Amazon
margins a beat at
sees
10.7%
Q2 net
on
sales of
estimates of
144 to
7.63%.
149
North American
billion.
net sales a beat at
That's below the
$86.34 billion
$150.2 billion
on
estimate
estimates of
for AMZN.
$85.55 billion.
Shares of Amazon are selling off here, down about $10 at the lows on AMZN. SWKS Skyworks. Skyworks reported adjusted earnings of $1.55. The estimate was $1.52. That's a beat. Revenue of $1.05 billion. The estimate was $1.05 billion, so that's in line. Sales beat on earnings for SWKS. CHK, Chesapeake. Chesapeake reported 56 cents in earnings adjusted. The estimate was 64 cents. So that's short for Charlie Hotel Kilo. Shares of Amazon now reversing sharply and moving higher. $186.43.
Shortly expecting Starbucks Q1 2024 earnings. Estimated EPS 80 cents. Estimated revenue $9.13 billion.
Iceberg ESM for CME buy at 50.70 crossed 500.
Block trade and ticker, UGI.
SBUX, Starbucks reporting 68 cents.
Starbucks
The
second
estimate
quarter net
for
revenue
Starbucks
$8.56 billion, which is a miss on
was
estimates of $9.13
74
billion.
cents of that short for Sandy Bravo
Starbucks second
Uniform
quarter
X-ray
adjusted EPS
SBUX.
68 cents, which is a miss on estimates of 80 cents.
Revenue of 8.56 billion. The estimate
Starbucks
was
Q2 China comp
8.53
sales
billion,
minus
so that is a
11%, which is a
beat for Starbucks. On revenue, a miss.
Starbucks Q2 China comp sales minus 11%, which is a miss on estimates of minus 1.62%. Starbucks Q2 US comp sales minus
A miss on
3%, which is a
earnings
miss
for
on estimates of
SBUX.
plus 2.31%.
PINS Pinterest reporting.
Starbucks Q2
Pinterest
international
reporting
comp sales minus
20
6%,
cents.
which is a miss on estimates of
The
plus
estimate on Pinterest was
1.36%.
13 cents. That's a beat.
Starbucks Q2 North America comp sales
Revenue
minus
Block trade
3%,
and
which is
ticker
a miss on
KVUE.
estimates of
Block
plus
trade and ticker
Of
7.
739 million is a beat for Papa India November Sandy. PINS.
Starbucks Q2 comp sales minus 4%, which is a miss on
MDLZ
estimates of
Mondelez.
plus 1.46%.
Mondelez reporting. Mondelez
Starbucks
reporting
shares sink
adjusted earnings of
7.4% as
95
Q2
cents.
comparable sales miss estimates.
The estimate was 89 cents, so that's a beat for Michael Delta Lima Zulu. Revenue of 9.29 billion for Mondelez is a beat. SMCI Supermicro reported $6.65.
So at 4:15 p.m. Eastern Time, we get AMD's first quarter 2024 earnings, estimated EPS at 61 cents, and estimated revenue at $5.44 billion.
$5.84. That's a beat for Sandy Michael Charlie India. LC Lending Club, 11 cents. The estimate on Lending Club was 3 cents for Lima Charlie. ATEN, A10 Networks reported $0.17. The estimate on A10 Networks
Block trade and ticker HRL. Block trade and ticker BEN. Block trade and ticker SNAP.
Shares of Amazon, AMZN, now at 182.33, off the highs, up about $7 on Amazon. Coming up at 4:15, earnings from Advanced Micro Devices expecting 61 cents for AMD. SYK Stryker reported $2.60. The estimate on Stryker.
At 4:15 p.m. Eastern Time, we get AMD's first quarter 2024 earnings, estimated EPS 61 cents, and
Was
estimated revenue at
$2.36.
$5.44 billion.
That's Sandy Yankee Kilo. Shares of Pinterest, PINS Pinterest, right now are off the highs at $41, up $7.55 on that report. BLKB, Blackboard, reporting 93 cents. The estimate was 89 cents for BLKB. MMSI, Meritage Homes, filed mixed security shelf. Michael, Sandy, India.
Shortly expecting AMD's first quarter 2024 earnings.
LUMN, Lumen Technologies, reported a loss of 4 cents. The estimate was 8 cents in the estimate was 0 earnings for LUMN, Lima Uniform Mike November.
Seeing AMD's
AMD,
earnings coming
Advanced
through,
Micro
adjusted EPS
Devices,
62
reporting
cents. That's a beat on estimates at 61
62
cents.
cents. The estimate
Revenue
on
$5.5 billion.
AMD
That's a beat on estimates $5.4 billion.
was
R&D
61 cents. That's
expenses
a penny beat for Alpha
$1.53 billion.
Michael Delta. Revenue
That's a beat on estimates $1.5 billion.
$5 billion.
Adjusted operating income $1.13 billion.
So that's a beat
A
for
beat on
Alpha
estimates
Michael Delta.
$1.11 billion. CapEx $142 million. That's a beat on estimates of $118.4 million.
Outlook for
Adjusted
Q2
operating
revenue
margin
of $5.7 billion
a beat on estimates of
for
20.8%.
AMD.
So AMD sees second quarter revenue at
Advanced Micro
$5.4 billion to
Devices shares
$6
are
billion, previously
trading
seeing $5.72 billion.
slightly lower now, $157 following that report.
And AMD sees second quarter adjusted gross margin at about 53% on previous estimates of 53%.
CLX Clorox reported $1.71. The estimate was $1.37. Sales of 1.81 billion is short of the 1.87 billion estimate for Charlie Lima X-ray. Unum Group reporting revenue of 3.2 billion. The estimate was 3.208 billion. So that's a bit short for UNM.
So AMD shares fall 2%
Adjusted
after the
earnings of
earnings report.
$2.12. The estimate was $1.97 for Uniform November Michael. MANU, Manchester United, naming Jean-Claude Blanc as CEO until July 13th. Michael F. in November uniform. PG and PCG nears deal with KKR for stake in power business. PG&E would spin off power assets, sell KKR 49.9%. That's Papa Charlie Golf. PCG. PRU Prudential reporting $3.12. The estimate on Prudential was $3.13, so that's a penny short for Prudential. Shares of PCG initially moving higher, now trading slightly higher, $17.30 on that Wall Street Journal report. Prudential files for debt shelf, size not disclosed. That's PRU.
At 4:30 p.m. Eastern Time, we get our weekly US API data. Crude oil stock change prior minus 3.23 million. Cushing stock change prior minus 0.898 million. Distillate stock change prior 0.724 million. And gasoline stock change prior minus 0.595 million. Bear in mind, we do get this data from public sources, so it can come out slightly after the matter.
Cadence, KAI reporting $2.10. The estimate on Cadent was $1.88 per kilo alpha India.
Block trade and ticker, CART.
Shares of Root following their report, spiking here $85.
Block trade and ticker, VTRS.
Shares up about $15.50 on Root.
Taking a look at the market wrap for today's session, the stock market fell in the final days of April and bond yields rose on concerns that stubborn inflation will force the Federal Reserve to keep interest rates higher for longer.
Reported
On the eve of the
76
Fed's
cents. That's a
decision,
penny
a
beat
broad
for
measure of
hotel
US labor costs, closely watched
India.
by policymakers, rose the most in a year. The data indicated wage pressures, reinforcing bets that the officials will keep interest rates unchanged at a two-decade high on Wednesday and are not likely to lower them anytime soon. That perception, combined with a drop in consumer confidence, weighed heavily on stocks, which experienced their worst month since September. The last time Fed Chair Powell spoke, he mentioned the lack of further progress in lowering inflation, as well as the labor market's continued strength. The latest inflation signals, combined with expectations for a strong employment report on Friday, are likely to convince him to change his mind. The S&P 500 dropped 1.6%, the most since January. Amazon rose in late trading after exceeding earnings expectations. Starbucks reported its first sales drop in over 3 years. Treasury 2-year yields rose above 5%, the highest level since November. The dollar made its fourth consecutive monthly gain, the longest winning
Block trade
streak
and
since
ticker,
September
D.
2022. At 4:30 p.m. Eastern Time, we get our weekly US API data. Crude oil stock change prior minus 3.23 million. Cushing
NDAQ,
stock change
NASDAQ
prior
files for
minus
mixed shelf, size not
0.898
disclosed,
million.
November Delta
Distillate
Alpha
stock change
Quebec,
prior 0.724 million.
NDAQ.
And gasoline stock change prior minus 0.595 million. Bear in mind, we do get this data from public sources, so it can come out slightly after the matter. Shortly expecting the results of the US API data, I'll lead with the crude oil stock change.
Crude right now at 81.60 following the API data, waiting for those numbers now. PEP, PepsiCo raising their quarterly dividend by 7% to $1.35.5. That is Papa Echo Papa, PEP. QUAD, Quad Graphics, reported 10 cents. The estimate on Quad Graphics was 2 cents, so that's a beat for QUAD. Tesla tweeting, Tesla Vision Auto Park now rolling out to vehicles with ultrasonic sensors in the US and Canada. TSLA. Tesla CEO Musk said Tesla will grow supercharger network at a slower pace.
Certainly an
PARA,
interesting.
Paramount, and Charter agreed to extend talks on contract renewal. That reported by Bloomberg.
Certainly an interesting evening so far with some of these earnings. We're going to bring AMD on screen.
Block trade and ticker, LSXMA.
So you can take a look at what's going on there with that semiconductor stock. I did just post their earnings. It looks like it was a double beat, EPS by a cent, 62 cents versus estimate of 61 cents. Revenue of 5.5 billion versus an estimate of 5.45 billion. So,
Crude, a build of 4.906 million. Gasoline, a draw of 1.48 million. Diesel, a draw of 2.187 million. That's the API data.
So coming into earnings, AMD looks like it was a beat, but the guidance is being revised lower. And I think the market's not terribly happy about that. AMD trading down about 4% after hours here. Let's bring up
Seeing crude coming
SMCI.
at a build of 4.906 million, a build of 4.906 million. Cushing, a build of 1.479 million, a build of 1.479 million. Gasoline, a draw of 1.48 million, a draw of 1.48 million. And diesel, a draw of 2.187 million, a draw of 2.187 million.
We're going to just backfill some of this data where we can on these, so just bear with me as I pull that data from the exchanges. And how are you folks doing out there? Anyone got any questions? We'll get the Amazon conference call coming in about 38 minutes, so I will live stream that.
AMZN, Amazon CFO on their media call said 61% of unit sales were from third-party sellers in Q1. That's Alpha Micro Zulu November.
Doesn't seem to be backfilling here. Let me give it another shot. SMCI did backfill, however. So we can see the volatility in this one. Let's just zoom out. You can really appreciate that crazy spike and drop. Someone in one of the rooms asked me to view this one. And I suppose we can kind of see why. So SMCI had a big pop up to 930 and change. Now it's given a bunch of that back, actually moving lower here down to 816 and change in the after hours trade. Let's see if we got that backfill on AMD. We did. So let's see what we can do about kind of zooming that one out just for a little more context. So after hours, you had that head fake higher. As often is the case, you get an initial move that's kind of the opposite of what the ultimate move is. And then we had a pretty big push lower in AMD. AMD beat. It was a double beat, but guidance was softer than expected. And that's not what we wanted to see. So we see the market reacting negatively to AMD's earnings so far. Let's take a look at when AMD's conference call will be. Looks like their conference call is set to start at about 5 p.m. So it's going to be similar timing to Amazon's call, so I won't be able to cover them both. But at the very least, we can take a look at their presentation here, and I'll put a link to that out there.
Marijuana moment, tweeting now. Senator Schumer says DEA marijuana rescheduling decision is historic, but he remains strongly committed to passing banking and legalization bills. That's from Marijuana Moment.
That's a really big deal, what's happening in cannabis. Maybe we'll take a moment to talk about that ahead of earnings, the earnings call from Amazon. But I would just say that this has been a long time coming, and it is transcendent for the industry because it opens up the possibility of really a lot more legitimate business, a lot more scaling of interstate commerce, better safety protocols that are national in nature rather than sort of a state by state patchwork. Also, the ability to export product to neighbors like Canada. Like this opens up a lot of doors. It also is, to some degree, it would be criminal justice reform progress. So I would say we're getting closer. To making some progress that makes some of the companies in this space quite attractive to consider investing in. That's one of the reasons that MSOS is getting that really strong bid, and it's up 24.83% today. And remember, we were talking about this on a podcast late last year, that this was one of the turning points that I was really waiting for. And I'm kind of looking forward to see how it all plays out. I think there will be some interesting opportunities in the space because a lot of these
Bloomberg
companies
reporting
were
now.
just beaten down.
PG&E confirms talks with KKR for a transaction. That's
And the
Papa
thing is,
Charlie
if you
Golf
think
and
about what this
Kilo
means
Romeo.
for this sector, it means that they'll be able to start deducting business expenses, which means improved margins. It means that you'll have the ability to vertically scale in multiple geographies and send inventory back and forth, which has been a big problem. This, areas of less than a necessary inventory, areas of an abundance of inventory. There's just a lot of things that this kind of opens up for the industry. So, I'm excited to see where it goes, but I'm also not particularly surprised to see the insane reaction in MSOS today because finally, after so long, we're starting to see progress on this key area.
CGC Canopy Growth now popping to new highs. Charlie Golf Charlie,
Now
1555.
That's a little weird, I will say, though. I would be more inclined to want to be bullish of the U.S. cannabis producers than the ones in Canada, because unless the United States opens up its borders to, importing cannabis from Canada, this isn't really a big
Amazon CFO
catalyst
says sees CapEx
for
higher
those
in
companies.
Q2 through Q4 versus Q1.
So I would look at that,
That's
bid in the Canadian
AMZN.
stocks with just a little bit of skepticism. I would favor the U.S. companies. I think Green Thumb is one to look at. There's some nuance here, and we do need to put on our fundamental hats and look at some of these companies that are trading at or below book value, that have good vertical scale, that have the capability to realize improved margins, where they can start to expand into other legal states and build a framework, because that's where this is ultimately going. It's kind of heading in a direction of cannabis becoming legitimized as a business, and the strongest are going to thrive. A lot of the weakest won't survive. That's how these kind of situations play out. So the companies that don't have management that are executing well, that aren't able to vertically integrate and therefore won't be able to compete on a cost basis, those are the companies that will be in trouble in this environment. And then, the other sidebar conversation is the Canadian companies. And again, unless there's like opening up of US borders to importing cannabis from Canada, I don't necessarily see them being big beneficiaries here. I really think it's going to be the vertically integrated cannabis companies in the US that are able to get into multiple key legal states and build oligopolies, because that's where this type of industry really does well. Ultimately, it's a plant. It's being grown to a flowered state. And if you start to integrate that with vertical farming and automation and other kinds of techniques, you can reduce your cost basis and either expand your margin, or like Jeff Bezos says, your margin is my opportunity. You can blow your competition out of the water by cutting prices and still having some profits where they can't compete. So the sort of Walmarts and Amazons of cannabis are going to be the ones that absolutely crush it in this changing order of how cannabis business will be looked at as time goes on. So I think that, it's important. What happened there is big. It's something that we should take seriously, and we should look for further progress. But on the other side of it, I will say this: guard your expectations on timelines. Americans have wanted, as a majority, legalization and decriminalization for decades. And in the last decade, it's like a near universal consensus. You see red states and blue states legalizing cannabis. But on the other side of that, there is more federal legislation that's going to be necessary to really kind of kickstart this to be a nationwide phenomenon, to legitimize banking and
Block
otherwise.
trade and ticker
And
X.
the chances of that legislation passing on an election year when no one wants to hand the other party a win are very low. So it'd be much more likely to happen depending on the composition of the White House and Congress in maybe 2025 in the next session. So that's the other thing, is like this pop that we got right now, it's great. It may go on a little longer, but it probably will fade until we start to see more legislative progress that makes this more realistic for investors. A lot of folks probably short covering on this headline, probably got a lot of momentum traders buying it in excitement, and nothing wrong
Donald
with making
Trump
money
says
on
raises
news-driven
trade and
catalysts.
ticker
Trump Media and
VFX.
Technology
Block
to
trade and ticker
64.9% as of April 26th versus 57.6% as of March 25th. That's DJT.
So, it's progress. It's not the finish line. We're maybe a quarter of the way there. And I think that's the other side of it. Like, the excitement makes sense. I get it. I'm all for it. But let's be careful now because, unless you're acquiring positions on a very long time horizon, you might be waiting. And in that wait, there might be some chop and some corrective selling as well from wherever this peaks out. So that would be the other side of it. Like, I'm all for it. I'm bullish over the next 5 or 10 years. But I think we really need to see some more legislative progress. Descheduling is a big step in that direction, but now we have like near gridlock. I mean, this is a Congress that can't pass a budget.
SMCI Super Micro shares pulling back here now, 790.05.
Oh, wow. Let's pull that up. Look at this
Following
one.
their earnings report hit a high of $947.75. Now I reversed big and pulling back.
SMCI, that's not being
SMCI,
received
Sandy
well by the
Microtrelli
stock
India.
here. Let's just take a look at that over a larger time frame here. So on a larger time frame, that is pulling us back to an area that is basically a low volume node on the chart. It actually had us cross through a low volume node on the chart. Let me correct
Amazon
myself.
CFO said headcount growth is in logistics and delivery. AMZN.
So SMCI is trading down to this red line or
Amazon
thereabouts
shares
after
now
hours. It's
trading
very
up about
volatile.
$5.
You can see that
off the
suggests we're going
highs.
to push to the bottom of the cloud and put SMCI into a potential downtrend tomorrow if this price action is not reversed by open. Okay, so we do want to see how this holds up here. If we get a rebid and we're able to get above this low volume sort of decision area, and you could see how things like price in this zone tends to get pretty choppy because people aren't really executing with much conviction around here. So, around this area is sort of the chop zone. It's where the market gets to decide where is SMCI going next from here. But if you look at SMCI and its price action, what does it tell you lately? Right? It's first, it's starting to sort of consolidate, but then it makes a decisive lower high. Right? And so that lower high is giving you an impression of, we may not be in an uptrend as much as we were. We may be, starting a downtrend. Then we make a lower low, right? And now it looks like we've just made another lower high and are continuing to potentially, if we take this last low out, make another lower low. I would be concerned about that for SMCI because the thing about this company is I don't see any competitive edge that is durable. I don't see how SMCI remains competitive over a long period of time. Because the thing is, NVIDIA has their own sort of proprietary ecology with CUDA. That keeps people interested in NVIDIA products, a little bit more retention, right? There's a lot of cost to move away from NVIDIA. It's possible, but you have to be willing to adapt your code to OpenCL, and you have to run some kind of abstraction layer where the legality may be a little iffy because NVIDIA is cracking down on that for intellectual property reasons. So what does that end up meaning? Well, with SMCI, if you don't like their prices, you can replace them with a Dell or an HP or another integrator.
PCG and KKR enter into exclusive talks on strategic partnership and Pacific Generation transaction. That's Papa Charlie Golf and Kilo Kilo Romeo. KKR, that's confirmed now.
So I would be just looking at SMCI with a little bit of skepticism here because I'm not convinced that this company is out of the woods overall. They're a hardware integrator. They're not a semiconductor. So they're not anything like NVIDIA. They don't have that proprietary ecology. And while NVIDIA is appreciably seeing competition increase, it's much more pronounced with SMCI. There's definitely more competition coming up for this company than what you see with NVIDIA. And I think that's a concern for investors because the margin that SMCI is able to earn is not sustainable. It's going to reduce over time as more competitors enter the space of, GPU compute node hardware integration, right? And so what does that mean? It means that SMCI now has to compete with the likes of all the biggest computer companies around the world. And those companies are used to making very small margins on hardware sales, which means they're going to take the margins way down so that they can accumulate more market share in this space. That's how they operate. It's kind of why the computer hardware industry is such a challenging space, because you just don't make money. And so if the market starts to realize that with SMCI, I'd be very concerned that, as sad as it is to say, but a lot of this upward move that we had could be given back, right? If that whole idea of your margin is my opportunity takes this stock, appreciably lower, like let's say we make a new lower low here, right? Then we get to a next decision zone. That next decision zone's like around here, maybe around 615. Moving below that, like if it was to happen, really does make it likely that prices start to move appreciably lower, right? Then you can start to see prices move down to like 480 and change from there, because that's the next sort of magnet level of potential demand. So for now, I am very leery of this company. It's run up so much. I get the excitement behind it, and I'm, applaud all the people that absolutely killed it buying this thing. But I think its glory days are behind it unless it's able to pull a magical rabbit out of its hat and sort of reinvent the computer hardware industry, which has traditionally been a low margin industry where it's very, very competitive. And I think that, for GPU compute nodes, they're no longer sort of the de facto breadwinner. And we can't look at them the same way we look at NVIDIA, because NVIDIA is a seller of picks and shovels, right? So they're kind of like in the gold rush right now. People are buying
block trade and ticker CFLT, block trade and ticker VRT.
People are buying that stuff, right? So anyway, just something I wanted to rant about a little bit, because I've seen a lot of interesting price action in that stock. I do think that it's more likely to be a risky area to get too aggressively into. So for me, I would be very careful with SMCI, because I think there is a reasonable chance that it could see a pretty hefty haircut from here. All right, so Amazon earnings call, I believe, is at 5:15 p.m. Eastern. I will confirm that momentarily. Yeah, the Amazon earnings call is starting in 21 minutes and 16 seconds. Let's take a look at AMD's price action after hours here. Pretty well walloped here. The stock is down 4% after hours, so that's a nasty, nasty decline. You can see that there was also some level of absorption by sellers of buying attempts, right around this level, and that pushed us a bit lower as well. Now, futures are about to close, so let's quickly check in on what's going on over there. And we can see S&P 500 futures is still kind of close to the lower end of their range. That last hour sell down, that last 10 minutes was pretty brutal. And they even sold down after the earnings releases of AMD and Amazon. And, I think that we saw, if I had to kind of deconstruct what happened there, a couple pieces to the puzzle. First is about 30 to 40% of S&P 500 and really whole market trading happens in the last 10 minutes of the day. So you think about that. There's like 6.5 hours in a trading day, right? And in each of those hours, there's 6 slices of 10 minutes, right? So that means there's 39 slices of 10 minutes in a trading day. And yet 30 to 40% of all the trading is happening in the last 10-minute slice, 1/39th of that, sort of 10-minute slice period. That's pretty incredible if you think about how much is happening and how important that transactional activity is. But it also tells you something else. One of the things I talked about on my stream this morning was the idea that this is not a well-hedged market, and we have so many event volatility catalysts that it'd be kind of surprising if we didn't see folks try to put on some hedges. Well, I dare say I think they're starting to put on some hedges here. And I think that was part of what we saw in that last hour was some reasonably strong put flows that were coming in and trying to hedge into the Fed. I mean, look at how large that active put contract was today. Remember earlier today when calls were outpacing puts significantly on SPX? What a difference, several hours makes, because now we see the opposite. Look at the top two, hot call plus warm call together versus hot put and warm put together, right? Hot call and warm call together about 140,000. Hot put and warm put together about 215,000. That's a big difference. That tells you there's a lot of demand for those puts, particularly as we got into the later part of the day. And again, I'm going to suggest that part of that was hedging pressure. But that wasn't the whole story. There was also some real distribution here in the market. Right? This was a market where there were some people that were selling late day because we got well below the options implied low of the day as well, particularly here in the aftermarket. So I would just say, as we get into tomorrow, it's going to be a big day. We've got the Federal Reserve decision. I suspect they won't cut rates. I suspect they won't taper quantitative tightening. I suspect that instead their approach here is going to be one where they talk about more patience and needing to see more progress on inflation. And I think that the Fed still may cut this year, but I think any cut is a policy mistake that further reinvigorates inflationary pressure unless the economy really, really weakens. So first cut's really being priced in for September. It may even be the only cut of the year. I wouldn't be surprised if they have to walk that cut back and maybe even start hiking again by the beginning of next year. That would be kind of my contrarian call here, because I don't think we're out of the woods. I think that Janet Yellen and Joe Biden and all this late cycle stimulus really reset the impact the Fed was trying to make to slow down the economy and reduce inflation and help to rekindle the economy, but also because it was late cycle into a somewhat overheated economic environment overall because of supply constraints and some tightness in the labor market and other areas. I believe that that's one of the reasons that inflation came back, because the government is now engaging the most aggressive stimulus. It's the highest level of deficit spend as a percentage of GDP with unemployment this low. And so, of course, in that environment, you're going to create demand.
Back here again, 150.72.
You're going to create more demand than the economy can handle. And I think that's what now gives the Fed pause. The government spent basically a year plus or a year and a half fighting the Fed.
SMCI Super Micro shares off the lows now, $792.
Doesn't look very off the lows to me, but they spent so much money trying to boost the government of impact on the economy, and so that added all this aggregate demand to non-residential fixed investment, right? And as a result of that, demand, unfortunately, you have an economy where now we're seeing inflationary pressure picking back up, and that's giving the Fed pause. So they were flying the mission accomplished banner in November, maybe not full well realizing that fiscal largesse, that late cycle demand that was being put into play. But now we're in an entirely different environment where we've got to look at inflation with some degree of nuance and appreciate that, this isn't an environment where the Fed's dual mandate says they should be cutting. But there's also another element. It's really important to think about it this way. It's really important to kind of contextualize the market as being more than the Fed. And the reason I say that is because, we had this impression that, the Fed, you can't fight them. They are the market, and that was all reset last year, wasn't it? Right? The government did everything they could. They fought the Fed, and in some senses, they won. They won by losing, right? They won by adding fiscal stimulus at a time where we really needed the opposite. We needed meaningful tightening. But that showed you something. It showed you the Fed isn't the market, right? And as a result, the other side of it is when you look at the size of the Treasury market, the Fed might be like a sixth or a fifth or whatever of it, maybe less, depending on how aggressive they are at auctions, what kind of QE they were doing at the time. Well, that's important because all those other folks have a say too. Now, typically the market would go along with the Fed's policy because the Fed's policy would go along with their dual mandate. And that would mean unemployment's rising. The economy is slowing materially, so prices are dropping. So then rates are coming down. So the Fed's adding stimulus into an environment where rates are naturally coming down. That's not to be unexpected, right? But if the Fed starts cutting into an environment where there's already baseline inflation and the economy isn't weakening as much as it has, then rates don't necessarily have to go down. This is not something that is well appreciated in all the discussions. I have a lot of people kind of come into my replies and say, oh no, the Fed has to cut because of the deficit, because of how much is being outlaid for interest. That suggests the
New
Fed
Zealand's
is the entire
financial
bond
system
market.
remains strong. Reserve Bank of NZFSR.
But the Fed is not the entire Treasury market. The Fed is one player in a much deeper, larger global market. It's kind of important, isn't it, to think about it that way? Because what if the market doesn't agree with the Fed? It didn't agree with the Fed for a chunk of last year. Rates didn't do what the Fed wanted. Financial conditions didn't do what the Fed wanted. The housing market didn't do what the Fed wanted. Frothy asset prices didn't do what the Fed wanted. So what makes us think that on the other side of the coin, that the Fed's going to have its way? That if they cut this year, it's actually going to reduce the government's financing costs? I'm very surprised this is not being discussed more, honestly. Because in my mind, it's actually one of the most important conversations we should be having, that actually cutting could be a policy mistake that has no positive impact. And it could even have a negative impact. Could stimulate some degree of inflation by bringing back some kinds of demand while not necessarily alleviating the burden that this fiscal largesse has created for the government, where year over year by April of 2025, they may be spending 1.7 trillion on interest. It's already over $1 trillion year over year from March 2023 to 2024. That's a big outlay. That's bigger than our defense budget, right? The defense budget's over 900 billion. The interest outlay is over $1 trillion. So what makes us think that with that kind of fiscal largesse, with deficit spend, the highest percentage of GDP it's ever been with unemployment this low, that we're just going to magically have the market follow the lead of the Fed? The only way that really happens is if the economy weakens meaningfully and inflationary pressure deteriorates. If that doesn't happen, I don't think the market's going to follow the Fed. Remember when people used to talk about bond vigilantes? That was just really the Treasury market saying, no, we're not buying what you're selling us. We don't believe that this is a good idea. That can still happen. There's a lot of counterparties in the Treasury market that may not necessarily want to go along for the ride. Now, there's talks of changing the reserve requirements for banks so that they can take on as much Treasury risk as they want to, and it doesn't count on their leverage ratios. That would be a freaking disaster if they do it. They may, to create another bidder of sort of first, second, and last resort for Treasuries, because, eventually they're probably going to have to increase the duration on this stuff, and there's not going to be that many buyers with no term premium. But, at the end of the day, I still think the market's much bigger than the Fed. I think 2023 was a lesson on that on the one side. In tightening, the market, the economy fought the Fed and won. So how do we know that they won't win on loosening? That's something I think everyone should think a lot about as we hope for rate cuts, because they may not be what we expect them to be. And I'm not saying that because I'm necessarily bearish. I still think there's a lot of opportunity in this environment. I've been saying, kind of talking from the tops of mountaintops about buying energy stocks late last year, which have been a killer investment. And then getting into industrials and materials and metals and mining this year, and then adding utilities and aerospace and defense, although I was pretty bullish on aerospace and defense last year too, because I mean, let's face it, the world's been crazy, right? And we made some killer calls and we made some good money. But on the other side of it, none of that's changing. If they continue down this path of re-accelerating inflation, I'm still super bullish of all of that. Because at the end of the day, utilities are a place for defense, but also a place of growth because of the doubling of power demand over the next decade. Aerospace and defense is an area that just has an unlimited implied bid because things just keep getting crazier and governments keep throwing more money at defense. Industrials, materials, metals, and mining, they keep running in an environment where prices are appreciating of what they're selling. They tend to realize better revenues and even better margins. So for all those industries, I'm still bullish. I'm just not bullish on things that are long duration risk proxies. So when you start talking about tech, especially out of big tech, I don't want to be there. We talked about it on Navigating the Markets over the weekend. If you haven't checked out that episode, I highly recommend checking it out. It went into detail as to what all was going on, right? All the rotations we're seeing and what's driving that. And I think it's really important to contextualize that this is that theme I've been talking about since last year that I said could take shape because of a policy mistake. The theme is from abundance to scarcity. And the idea is that, we went from a period of time where we had a natural abundance. Now we're in a period of time where we have some degree of artificial scarcity in a lot of areas and some degrees of natural scarcity. And that's impacting energy, metals, agriculture, labor, power generation and transmission. It's a number of different areas that are leading to higher and higher prices. And that is something that if the Fed cuts into that and the government stimulates into that, that just reaccelerates inflation. So I would just be very mindful that, this cutting cycle, should it come to fruition, is likely to be a policy mistake. The market may not follow the way it has in the past because it's a different set of economic variables playing out now than has previously. So we're just about 8 minutes away from the Amazon conference call. I will be streaming that live on my YouTube and Twitter. I don't have an easy way to do that on our Discord, unfortunately. But you can definitely just go to Amazon's website. Their investor relations page has a link. You can register. You don't have to share your real email address and be spammed into oblivion because it doesn't require you receiving the link. It just requires you sharing the registered email address. So I just tend to use throwaway emails for stuff like that, or just make up an email, whatever. But, don't put it in your main box. Don't get on an infinite amount of spam lists in the world of finance. It becomes pretty difficult to climb out of all that spam. But ultimately, folks, I think that Amazon, I didn't really have too many concerns about their earnings. Their guidance being soft is interesting. I think that is to be expected. This is a company that makes a lot of money on e-commerce, and e-commerce has a lot to do with the health of the consumer. And we know the bottom two quartiles of consumers in this country are not doing as well. They're pulling back on restaurant spend. They're pulling back on discretionary spend. They're pulling back on car buying. They're pulling back on durables for their homes overall in aggregate. And if we're talking about things in real terms, okay, so let's be clear. I'm not talking about nominal terms. I'm talking about netting out inflationary pressure in real terms. Consumers are paying more, so it looks great in nominal terms, but they're getting less or the same. And that's the inflation reality of it. So it looks great until it doesn't. And we've kind of reached that elastic point where the rubber band starts snapping back because consumers have maxed out their credit cards. They've maxed out other revolving lines of credit. They're paying the highest level of interest, and they have the highest level of credit card debt they ever have. And I think this is kind of showing how stretched a lot of familial budgets are. Now, the top 25%, they're loving it. Their asset prices are high. They're earning interest while others are paying more. They're still in a very good spot. And so that's why you don't see this well distributed. It's what I've been contextualizing as a K-shaped recovery, because for so long it's been exactly that. There's the upper quartile that are loving it, and there's the bottom two quartiles that are hating it. And it's only gotten worse for those bottom two. And we do see some of the upper folks pulling back a bit, but that's more because of perceived lack of wealth inflation, right? They're not seeing the market continue to make all-time highs. They're seeing some hits in their real estate and bond portfolios. So they're pulling back a little bit on spending, but for different reasons, right? So I think it is important to look at this as, yeah, we could run into some turbulence. The last GDP print wasn't particularly impressive. A lot of the growth was led by the financial services, medical insurance, health costs, other kinds of things like that. Automobile insurance, homeowners insurance. I'm sure everyone listening, looking at their statements, if they're in the US or other places that are doing this, they've seen their insurance costs surge. And they're like, yeah, I can relate to that. And the inflationary readings don't necessarily reflect what I'm dealing with in my life. Well, then extrapolate that to like the bottom half of all of America, because like everyone's dealing with that in one way or another. And if you're a renter, it still gets passed on to you in other ways. Like if your landlord has to pay a higher property tax, a higher insurance, higher utilities, all these things are happening, they're going to pass that on to you in a higher rent when you have to renew your lease, because they have to. They can't just eat all of that. So there's still more sort of pressure in the pipeline for upward prices. But again, that just has me bullish on different parts of the market. The thing that we have to realize is what may sound like doom and gloom to an uninformed audience is actually opportunity if you know where you are in the cycle. What may sound like, oh God, that's really bad. Well, if you're all in like, mid-cap growth, yeah, it's really bad. You don't want rates going up. You don't want inflation reaccelerating. You don't want the Fed being unwilling to cut. But if you're in profitable value companies that are cyclical players that have clean balance sheets and strong free cash flow, this environment's perfectly fine, especially if they have pricing power. It's all about where you are. So, I've been misread way too often as being bearish on all kinds of things. And yet I'm sitting here net long like all the time. It just depends on where I'm long, what I'm long, how I'm playing it, or if I'm pair trading it in a way where I'm taking advantage of relative strength mirrored against relative weakness. The reality is that even the most bearish person you'll ever meet isn't really net short. No one is that wants to survive. You can't be. The markets do, especially in the US, tend to go up. So you've got to be very careful about how you pick those tactical shorts, but you shouldn't still be like full portfolio net short with leverage. That rarely ever works out for anyone. That is something that also your upside potential, your profit realization potential is limited. There's unlimited upside implied in a stock or a futures contract, but it can only go to zero. So you can only short so much. You can only make so many gains. And you'll say, aha, but what about the leverage ETFs? Well, they have their own set of problems, and one of them is decay. So at the end of the day, I feel like people are a little too quick to kind of read what other people's biases may be and then imply that this means their positioning is X, Y, and Z. And the reality is often quite a bit different. Everyone can have an opinion. In fact, there's a lot of people that in 2022 were bearish as hell, but still had all their investments and were long. So their sentiment didn't reflect their positioning. So I just want to kind of rant about that a little bit because I think it's an area that often gets misunderstood. And, it's an area that needs some further conversation because there's more nuance necessary, right? The other thing that people tend to get in fights about are timeframes. A day trader talking to a swing trader, talking to an investor, they could all three be right, but in their time frame. And so they could all sit there and argue with each other and think they're disagreeing, but maybe they actually have views that would reconcile with each other if they all knew what each other's timeframes were, what their setups, their risk tolerances, entries, and exits would be. Anyway, we're just about a minute 30 away from the Amazon earnings call. So I'm going to get off my little soapbox here as we prepare for the call. And then once the call wraps up, we can talk a little bit about it. We can have some Q&A, and then I'll wrap up the stream. But really appreciate everyone tuning in. It's always fun doing these and, getting to kind of rant about all the things that are on my mind. And just about 50 seconds away from that Amazon earnings call. So we're going to be switching over to that. If you're on the Traderade Discord, just switch over to my YouTube or Twitter stream if you want to hear the call or register on Amazon's website. feel like we're listening to Muzak here. Like the music on all these earnings calls, it kind of gives you a flavor for the personality of the company. Meta's was kind of very out there, almost sounded like it was from a different world. Tesla's was like upbeat techno music, kind of inspiring of like an AI robotics future. And then this is like elevator music, honestly. Like I feel like I'm waiting for my Amazon customer service representative to get back on the line and tell me whether I can return my product or not. Your approximate wait time is 5 minutes. You are number 3 in the line. Your call is very important to us. Please continue to wait as we do other things that are more important than you. Thank you for shopping at Amazon. Oh, and I have to correct myself here. It looks like the Amazon earnings call is apparently supposed to start now at 2:30 Pacific, which is 5:30 Eastern, even though the event was saying that it was 5:15. So I apologize. Apparently their communications were not clear, or I'm a little fuzzy-headed, because it looks like we are going to be waiting just a little while longer. So let me go ahead and just sort of maybe pause that hold music there, since I don't know that we need to listen to that for that whole time. And I'll get back to some commentary here as we wait a little while longer. Again, I thought the Amazon earnings call would be imminent. It certainly the countdown timer made it seem like that was the case, but actually it's set to start around 5:30 p.m. Eastern time, 2:30 p.m. Pacific time. So rather than subject you all to more of that hold music, we can talk a little bit more about what all is going on. Futures are closed right now until about 6 p.m. Eastern, so we just have really the aftermarket activity in some of these stocks. AMD making a new low after hours here, getting down to 145 and then popping back up to 147.75. So that's kind of a big loss. This company is now down 6.67%. Earlier it was down over 7%. I don't think the market is particularly happy about the guide from this company. And I think it also suggests that weakness in chip demand, particularly for gaming chips, but some of these other areas, is something we may expect to see from some of these other players. Remember, Intel got smashed on their earnings. AMD is now getting smashed on their earnings. These are two very key semiconductors. I realize they're different than NVIDIA, but we should at least be concerned about the guidance that NVIDIA gives, because from all accounts, their sales growth is set to slow pretty materially. And I think we'll start to see that in this quarter's earnings guidance, right? So when they guide out for their subsequent quarters in this conference call and their earnings release, I think we're going to see some softness there too. This is a theme. I mean, you could kind of see it across the board. Tech is slowing a bit. And this is also something that wasn't entirely unexpected. We've actually talked about it a bit at MacroVisor, that we expected the earnings of some of the leading tech players to slow. And key sectors in the S&P 500's more inglorious 493 in places like energy, industrials, metals and mining materials, and otherwise, to start to see some earnings growth come back, sort of a handoff as a part of that broader rotation, not just in positioning, but also where economic activity is happening. So I think that's another thing to just be cognizant of, is that there are some big moving pieces happening underneath the surface. Like what kept the market buoyant for as long as it had been, it's starting to change now. Yes, we did get great earnings and guidance from Microsoft and Google, but we didn't get so much of that from Netflix. We didn't get so much of that from Tesla or Meta. We didn't get so much of that from Intel or AMD and SMCI. So I would just say, you know, let's guard our optimism and be a little bit more cautious about what our expectations are from Amazon's earnings call, from Apple's earnings. And I know they don't guide anymore, but from whatever kind of clues they give us, I expect Apple probably announce a big share buyback program, because that seems to be the key area of innovation that's happening at the company these days. But yeah, overall, I would just be a little bit more cautious. This earnings season is telling me that overall the market is less forgiving. And it really needs to see things kind of either beat really low expectations or kind of knock things out of the park if expectations are high, to really for the company to really do well. So I think we're in a bit of a different environment. It's a little bit more stringent. It's a little bit more risk adverse. People are content to lock in profits. You know, a lot of trades have done really well, and now we're starting to see what's doing well change to different parts of the market, both in terms of performance of stocks, but also, as we can see, guidance. And what is the market really pricing in? It's pricing in growth potential. And when that potential is being kneecapped by softer guidance, you know, the market's going to punish those stocks. And so that's part of what we're seeing too. One other thing I wanted to share before we get on the call, it's a little spicy, so bear with me for the spiciness. First, this is the SMCI chart. We talked about this earlier, where it could go, so that's nothing new. But let's look at this Tesla chart. This was one that I talked about as a short thesis earlier today on my stream, and I'm still very much adamant about it. The stock actually fell quite a bit since I posted this idea. But if we zoom out, this is why. Okay, so every time we reflect off this lower trend line or rejected below it, we see selling pressure accelerate. So I'm not looking for anything enormous. I'm just looking to trade this down to 157.45, or you know, you could look at this with mid-June puts running, buying the 157, selling the 156 vertical spread. Could also be an interesting way, a bearish vertical spread on Tesla puts in mid-June. You know, again, buying the 157, selling the 156 is also a way I would consider expressing a view on this one. But I think that pop is to be sold. I don't believe the company should have been bid up as aggressively as it was on a tentative nodding by the CCP to Tesla. We don't know what Musk offered in return to get that kind of nod. We don't know if it's going to stand, or if this is just something that's, you know, a bit of a news blurb that we don't hear anything more about for a long time. But what we do know is full self-driving is nowhere near ready. And so I would be very skeptical of that move being something that can sustain. And then today we got news that he's firing everyone from their supercharger unit, firing a bunch of people working on the new vehicles, and just continuing that campaign of cost cutting. So I think Tesla's got some room lower. I like fading it here. I did put on a short in the shares here when I called it out, and I'm still looking for this thing to trade lower. I think the path of least resistance in this overall longer term downtrend remains lower. So that's just something to keep an eye on. I don't want to offend any bulls, you know. I think the stock is still in a lot of trouble. That's all. So let's get to the Amazon earnings call, as now we're not too far away from it, you know, eventually starting. And maybe the quality of the music will improve a bit too. It looks like it's a little bit less obnoxious. Someone mentions it's interesting to see where U.S. equities are with the U.S. 10-year note and dollar index considered. I 100% agree. I don't think it's sustainable. I think with 10-year rates pushing above 4.5%, probably, quite frankly, easily to 5%, possibly as high as 6%, I think there is still more of a haircut to come. I would be pretty surprised if equities don't trade down to like SPX 4800 or so before the smoke clears. That's just my 2 cents. I mean, this market has run so much, and it's basically running on fumes. Positioning is still very extended. I went over all the slides earlier today, but I still think that we have room lower from here, and that's the path of least resistance. But, you know, the market is going to react to the Fed. It's going to react to Apple. It's going to react to the specificity of QRA, where the issuance is going to happen across the yield curve, and it's going to react to the labor market data. So we've got a lot of moving parts. We've got to see what the market tells us. We can't just kind of, you know, go with what we think is going to happen. We need to see what the market tells us. So I'm still inclined to believe that we see a lower low in this sell down, but you know, we also need to see if we have the momentum path there. We have to adhere to what signals we're being given rather than just try to kind of, you know, see what we want to see in all of this. It's a dangerous thing that traders need to avoid, is kind of like trying to believe that they're smarter than the market. No one really is. You might have hot streaks. It doesn't mean that you're going to consistently be able to beat the market. And in fact, a lot of the times, the best thing to do when you're having a hot streak is to take a step back and assess whether this is luck or this is sustainable, and you've kind of come to the promised land of trading. Oftentimes it is luck, and you have to kind of take a step back and not get into bigger size, and then eventually hurt yourself fairly badly. Somewhere Over the Rainbow? That's what they're playing right now. The instrumental of Somewhere Over the Rainbow. Good song, but kind of odd for an earnings call. As someone mentions, tell that to the guy who bought the SMCI calls. Yeah, Nick, I wish I could just say, you know, please be a little more careful sharing that stuff, because people will follow you and get absolutely killed. You know, it's really kind of sad what all is happening. I see a lot of accounts out there that are promoting the sort of risk-taking that will hurt people in ways that I don't know that they'll be able to recover from, both financially and their confidence. And, you know, they've been able to be right for some time. Like in 2023, it was very easy to just sort of throw spaghetti at the wall, and a lot of stuff stuck, especially in the Mag 7 and sort of peripheral tech and AI space. We're done with that period of time. It's now really a stock picker's market. And the folks that got lucky, they're not going to get lucky anymore. It's going to be much more effort required to be consistently successful. And I don't say that to throw shade at anyone. I'm just being honest. There's a lot of people that aren't going to make it this year if they don't start to adapt to the reality of how things are changing. All that fiscal excess last year helped to drive the market. That's over for the most part.
Good day, everyone, and welcome
Here we
to
go
the
with the call.
Amazon.com first quarter 2024 financial results teleconference. At this time, all participants are in a listen-only mode. After the presentation, we will conduct a question-and-answer session. Today's call is being recorded. And for opening remarks, I will be turning the call over to the Vice President of Investor Relations, Mr. Dave Files. Please go ahead.
Hello, and welcome to our Q1 2024 financial results conference call. Joining us today to answer your questions is Andy Jassy, our CEO, and Brian Olsavsky, our CFO. As you listen to today's conference call, we encourage you to have our press release in front of you, which includes our financial results as well as metrics and commentary on the quarter. Please note, unless otherwise stated, all comparisons in this call will be against our results for the comparable period of 2023. Our comments and responses to your questions reflect management's views as of today, April 30th, 2024 only, and will include forward-looking statements. Actual results may differ materially. Additional information about factors that could potentially impact our financial results is included in today's press release and our filings with the SEC, including our most recent annual report on Form 10-K and subsequent filings. During this call, we may discuss certain non-GAAP financial measures. In our press release, slides accompanying this webcast, and our filings with the SEC, each of which is posted on our IR website, you will find additional disclosures regarding these non-GAAP measures, including reconciliations of these measures with comparable GAAP measures. Our guidance incorporates the order trends that we've seen to date and what we believe today to be appropriate assumptions. Our results are inherently unpredictable and may be materially affected by many factors, including fluctuations in foreign exchange rates, changes in global economic and geopolitical conditions and customer demand and spending, including the impact of recessionary fears, inflation, interest rates, regional labor market constraints, world events, the rate of growth of the internet, online commerce, cloud services, and new and emerging technologies, and the various factors detailed in our filings with the SEC. Our guidance assumes, among other things, that we don't conclude any additional business acquisitions, restructurings, or legal settlements. It's not possible to accurately predict demand for our goods and services, and therefore our actual results could differ materially from our guidance. And now, I'll turn the call over to Andy.
Thanks, Dave. Today we're reporting $143.3 billion in revenue, up 13% year over year, excluding the impact from foreign exchange rates, $15.3 billion in operating income, up 221% year over year, or $10.5 billion, and $48.8 billion in trailing 12-month free cash flow adjusted for equipment finance leases, up $53.2 billion year over year. We remain focused on driving better experiences for our customers while also delivering efficiency improvements. Our financial results are an encouraging reminder of the progress we're making. Starting with our stores business, despite having hundreds of millions of items and the broadest selection available, we remain intensely focused on adding even more selection. One way is to continue adding brands we know our customers want. For instance, in the U.S., we recently welcomed Clinique and two Gen Z fashion favorites, Parade and Cider, and announced a collaboration with Hardly Ever Worn It in Europe to offer customers pre-owned items from luxury brands. Another way to drive selection is to make it easier for our third-party sellers to add their products to our store. We've recently launched a new generative AI tool that enables sellers to simply provide a URL to their own website, and we automatically create high-quality product detail pages on Amazon. Already, over 100,000 of our selling partners have used one or more of our Gen AI tools. We remain focused on making sure we're offering everyday low prices, which we know is even more important to our customers in this uncertain economic environment. As our results show, customers are shopping but remain cautious, trading down on price when they can, and seeking out deals. In Q1, we helped customers save with shopping events worldwide, including our first big spring sale in Canada and the US. We also held Spring Deal Days in Europe and a Ramadan event in Egypt, Saudi Arabia, and the UAE. Delivery speed really matters to customers, and we've continued to get faster while improving our safety performance. In this past Q1, we delivered to Prime members at our fastest speeds ever. In March, across our top 60 largest U.S. metro areas, nearly 60% of Prime members' orders arrived the same or next day. And globally, in cities like Toronto, London, and Tokyo, about 3 out of 4 items were delivered the same or next day. Faster delivery times have another important effect. As we get items to customers this fast, customers choose Amazon to fulfill their shopping needs more frequently, and we can see the results in various areas, including how fast our everyday essentials business is growing and the continued increase in Prime member purchase frequency and total spend with us. Over the past year, we've talked about how our regionalization efforts have helped lower our cost to serve. We've continued to inspect our fulfillment network for additional opportunities and are working on several areas where we believe we can lower costs even further while also improving customer experience. One example of this is our work to increase the consolidation of units into fewer boxes. As we further optimize our network, we've seen an increase in the number of units delivered per box, an important driver for reducing our costs. When we're able to consolidate more units into a box, it results in fewer boxes and deliveries, a better customer experience, reduces our cost to serve, and lowers our carbon impact. Another prominent example is our efforts to revamp our U.S. inbound fulfillment architecture to allow for better inventory placement closer to our customers. This will be an iterative process throughout the year as we work with sellers and retail partners, and teams are making good progress on their plans. Advertising performance remains strong, with ad sales up 24% year over year, excluding the impact of foreign exchange. The strength in advertising was primarily driven by sponsored products, supported by continued improvements in relevancy and measurement capabilities for advertisers. We still see significant opportunity ahead in our sponsored products, as well as areas where we're just getting started, like Prime Video ads. Prime Video ads offers brands value as we can better link the impact of streaming TV advertising to business outcomes, like product sales or subscription signups, whether the brands sell on Amazon or not. It's very early for streaming TV ads, but we're encouraged by the early response. Moving to AWS, year-over-year revenue growth accelerated to 17.2% in Q1, up from 13.2% in Q4. It's useful to remember that year-over-year percentages are only relevant relative to the total base from which you start. And given our much larger infrastructure cloud computing base, at this growth rate, we see more absolute dollar growth again quarter over quarter in AWS than we can see elsewhere. We're seeing a few trends right now. First, companies have largely completed the lion's share of their cost optimization and turned their attention to newer initiatives. Before the pandemic, companies were marching to modernize their infrastructure, moving from on-premises infrastructure to the cloud to save money, innovate at a more rapid rate, and to drive more developer productivity. The pandemic and uncertain economy that followed distracted from that momentum, but it's picking up again. Companies are pursuing this relatively low-hanging fruit of modernizing their infrastructure, and with the broadest functionality by a fair bit, deepest partner ecosystem, and strongest security and operational performance, AWS continues to be their strong partner of choice. Our AWS customers are also quite excited about leveraging Gen AI to change their customer experiences and businesses. We see considerable momentum on the AI front, where we've accumulated a multi-billion-dollar revenue run rate already. You've heard me talk about our approach before, and we continue to add capabilities at all three layers of the Gen AI stack. At the bottom layer, which is for developers and companies building models themselves, we see excitement about our offerings. We have the broadest selection of NVIDIA compute instances around, but demand for our custom silicon, Trainium and Inferentia, is quite high given its favorable price-performance benefits relative to available alternatives. Larger quantities of our latest generation Trainium 2 is coming in the second half of 2024 and early 2025. Companies are also starting to talk about the eye-opening results they're getting using SageMaker. Our managed end-to-end service has been a game changer for developers in preparing their data for AI, managing experiments, training models faster, lowering inference latency, and improving developer productivity. Perplexity AI trains models 40% faster in SageMaker. Workday reduces inference latency by 80% with SageMaker, and NatWest reduces its time to value for AI from 12 to 18 months to under 7 months using SageMaker. This changes how challenging it is to build your own models, and we see an increasing number of model builders standardizing on SageMaker. The middle layer of this stack is for developers and companies who prefer not to build models from scratch, but rather seek to leverage an existing large language model, or LLM, customize it with their own data, and have the easiest and best features available to deploy secure, high-quality, low-latency, cost-effective production Gen AI apps. This is why we built Amazon Bedrock, which not only has the broadest selection of LLMs available to customers, but also unusually compelling model evaluation, retrieval augmented generation, or RAG, to expand models' knowledge base, guardrails to safeguard what questions applications will answer, agents to complete multi-step tasks, and fine-tuning to keep teaching and refining models. Bedrock already has tens of thousands of customers, including Adidas, New York Stock Exchange, Pfizer, Ryanair, and Toyota. In the last few months, Bedrock's added Anthropic's Claude 3 models, the best-performing models on the planet right now, Meta's Llama 3 models, Mistral's various models, Cohere's newest models, and new first-party Amazon Titan models. A week ago, Bedrock launched a series of other features, but perhaps most importantly, custom model import. Custom model import is a sneaky big launch as it satisfies a customer request we've heard frequently and that nobody has yet met. As increasingly more customers are using SageMaker to build their models, they're wanting to take advantage of all the Bedrock features I mentioned earlier that make it so much easier to build high-quality production-grade Gen AI apps. Bedrock Custom Model Import makes it simple to import models from SageMaker or elsewhere into Bedrock before deploying their application. Customers are excited about this, and as more companies find they're employing a mix of custom-built models along with leveraging existing LLMs, the prospect of these two linchpin services in SageMaker and Bedrock working well together is quite appealing. The top of the stack are the Gen AI applications being built, and today we announced the general availability of Amazon Q, the most capable generative AI-powered assistant for software development and leveraging companies' internal data. On the software development side, Q doesn't just generate code, it also tests code, debugs coding conflicts, and transforms code from one form to another. Today, developers can save months using Q to move from older versions of Java to newer, more secure and capable ones. In the near future, Q will help developers transform their .NET code as well, helping them move from Windows to Linux. Q also has a unique capability called agents, which can autonomously perform a range of tasks, everything from implementing features, documenting, and refactoring code to performing software upgrades. Developers can simply ask Amazon Q to implement an application feature, such as asking it to create an Add to Favorites feature in a social sharing app, and the agent will analyze their existing application code and generate a step-by-step implementation plan, including code changes across multiple files and suggested new functions. Developers can collaborate with the agent to review and iterate on the plan, and then the agent implements it, connecting multiple steps together and applying updates across multiple files, code blocks, and test suites. It's quite handy. On the internal data side, most companies have large troves of internally relevant data that resides in wikis, internet pages, Salesforce, storage repositories like Amazon S3, and a bevy of other data stores and SaaS apps that are hard to access. It makes answering straightforward questions about company policies, products, business results, code, people, and many other topics hard and frustrating. Q makes this much simpler. You can point Q at all of your enterprise data repositories, and it'll search all this data, summarize logically, analyze trends, and engage in dialogue with customers about this data. We also introduced today a powerful new capability called Q Apps, which lets employees describe in natural language what apps they want to build on top of this internal data, and Q Apps will quickly generate that app. This is going to make it so much easier for internal teams to build useful apps from their own data. Q is not only the most functionally capable AI-powered assistant for software development and data, but also setting the standard for performance. Q is the highest known score and acceptance rate for code suggestions, outperforms all other publicly benchmarkable competitors on catching security vulnerabilities, and leads all software development assistants on connecting multiple steps together and applying automatic actions. Customers are gravitating to Q, and we already see companies like Brightcove, British Telecom, Datadog, GitLab, GoDaddy, National Australia Bank, NCS, NetSmart, Slalom, Smartsheet, Sun Life, Tata Consultancy Services, Toyota, and Wiz using Q, and we've only been in beta till today. I'd also caution folks not to overlook the security and operational performance elements of these Gen AI services. It's less sexy, but critically important. Most companies care deeply about the privacy of the data in their AI applications and the reliability of their training and production apps. If you've been paying attention to what's been happening the last year or so, you can see there are big differences between providers on these dimensions. AWS has a meaningful edge, which is adding to the number of companies moving their AI focus to AWS. We expect the combination of AWS's re-accelerating growth and high demand for Gen AI to meaningfully increase year-over-year capital expenditures in 2024, which, given the way the AWS business model works, is a positive sign of the future growth. The more demand AWS has, the more we have to procure new data centers, power, and hardware. And as a reminder, we spend most of the capital up front, but as you've seen over the last several years, we make that up in operating margin and free cash flow down the road as demand steadies out. And we don't spend the capital without very clear signals that we can monetize it this way. We remain very bullish in AWS. We're at a $100 billion plus annualized revenue run rate, yet 85% or more of the global IT spend remains on premises. And this is before you even calculate Gen AI, most of which will be created over the next 10 to 20 years from scratch and on the cloud. There's a very large opportunity in front of us. We also continue to make strong progress on our newer investments. Our emerging international stores are growing and moving towards profitability. Our third-party logistics business, offering services like Buy with Prime, Amazon Shipping, and multi-channel fulfillment, continues to grow well. We just launched a Prime delivery grocery benefit that lets customers receive free unlimited grocery delivery for just $9.99 a month, which is great value, and customers are responding accordingly. Later this year in Manhattan, we're launching a new, smaller Whole Foods Market concept called Whole Foods Market Daily Shop. Prime Video continues to produce compelling content, with Fallout being our latest big hit on the heels of the very successful Roadhouse movie, with strong customer engagement in our original and partner content. Our health services business is growing robustly as customers are loving our pharmacy customer experience, and we've launched same-day delivery of prescription medications to customers in 8 cities, including Los Angeles and New York City, with plans to expand to more than a dozen cities by the end of the year, with customers now getting first fill medications 75% faster year over year nationwide. And Kuiper is getting closer to having its production satellites in space and entering our commercial beta. There's a lot of invention happening across our business, and I'm super grateful to all our employees for their hard work and ingenuity. I'll close by sharing that I'm enthusiastic about how we started this year. We have a lot of opportunity in front of us in every one of our businesses to make our customers' lives better and easier. With that, I'll turn it over to Brian for a financial update.
Thanks, Andy. Starting with our top-line financial results. Worldwide revenue was $143.3 billion, representing a 13% increase year over year, excluding the impact of foreign exchange, and near the top end of our guidance range. I'd like to highlight a couple points to help you interpret our growth rates. First, we saw an impact from leap year in Q1, which added approximately 120 basis points to the year-over-year quarterly revenue growth rate. Second, while I typically talk about growth rates excluding the impact of year-over-year changes in foreign exchange, we did see an unfavorable impact from global currencies weakening against the US dollar more than we had planned in Q1. This led to a $700 million or 50 basis point headwind to revenue relative to what we guided. Excluding this FX headwind, we would have exceeded the top end of our guidance range. Worldwide operating income was $15.3 billion, which was our highest quarterly income ever, and it was $3.3 billion above the high end of our guidance range. This was driven by strong operational performance across all 3 reportable segments and better than expected operating leverage, including lower cost to serve. The impact on operating income from our Q1 FX rate headwind was negligible. I'll speak more to our profitability trends in a moment. In the North America segment, first quarter revenue was $86.3 billion, an increase of 12% year over year. In the international segment, revenue was $31.9 billion, an increase of 11% year over year, excluding the impact of foreign exchange. We remain focused on the inputs that matter most to our customers: selection, price, and convenience. During the quarter, around the world, we helped customers save with our shopping events. We added selection, including premium and luxury brands, and we delivered at our fastest speeds ever for Prime members. Third-party sellers continue to be an important part of our offering. Third-party seller services revenue increased 16% year over year, excluding the impact of foreign exchange. We saw strong 3P unit growth, coupled with increased adoption of our optional services such as fulfillment and global logistics. For the quarter, third-party seller unit mix was 61%, up 200 basis points year over year. Shifting to profitability, North America segment operating income was $5 billion, an increase of $4.1 billion year over year. Operating margin was 5.8%, up 460 basis points year over year. We saw improvements in our cost to serve, including continued benefit from our work to regionalize our operations, savings from more consolidated customer shipments, and improved leverage driven by strong unit growth and lower transportation rates. In our international segment, operating income was $903 million, an improvement of $2.2 billion year over year. Operating margin was 2.8%, up 710 basis points year over year. This is primarily driven by our established countries as we improve cost efficiencies through network design enhancements and improved volume leverage. Additionally, we saw good progress in our emerging countries as they expand their customer offerings and make strides on their respective journeys to profitability. Looking ahead, we see several opportunities to further lower cost to serve and improve profitability in our worldwide stores business while still investing to improve the customer experience. Within our fulfillment network, we are focused on investing in our inbound network, streamlining and standardizing process paths, and adding robotics and automation. These improvement opportunities will take time. However, we have a solid plan in place and we like the path we are on. Advertising remains an important contributor to profitability in North America and international segments. We see many opportunities to grow our offerings, both in the areas that are driving growth today, like sponsored products, and in areas that are newer, like streaming TV ads. Moving to AWS, revenue is $25 billion, an increase of 17% year over year, and AWS is now a $100 billion annualized revenue run rate business. Excluding the impact from leap year, AWS revenue increased approximately 16% year over year. During the first quarter, we saw growth in both generative AI and non-generative AI workloads across a diverse group of customers and across industries, as companies are shifting their focus towards driving innovation and bringing new workloads to the cloud. Additionally, we continue to see the impact of cost optimizations diminish. While there will always be a level of ongoing optimization, we think the majority of the recent cycle is behind us and we're likely closer to a steady state of these optimization efforts. AWS operating income was $9.4 billion, an increase of $4.3 billion year over year. As a reminder, these results include the impact from the change in the estimated useful life of our servers, which primarily benefits the AWS segment. We made progress in managing our infrastructure and fixed costs while still growing at a healthy rate, which has resulted in improved leverage. As we've said in the past, over time we expect the AWS operating margins to fluctuate, driven in part by the level of investments we are making in the business. We remain focused on driving efficiencies across the business, which enables us to invest to support the strong growth we're seeing in AWS, including generative AI, which brings us to capital investments. As a reminder, we define these as the combination of CapEx plus equipment finance leases. In 2023, overall capital investments were $48.4 billion. As I mentioned, we're seeing strong AWS demand in both generative AI and our non-generative AI workloads, with customers signing up for longer deals and making bigger commitments. Still relatively early days in generative AI and more broadly the cloud space, and we see sizable opportunity for growth. We anticipate our overall capital expenditures to meaningfully increase year over year in 2024, primarily driven by higher infrastructure CapEx to support growth in AWS, including generative AI. Turning to our revenue guidance for Q2, net sales are expected to be between $144 billion and $149 billion, or to grow between 7% and 11% compared with the second quarter of 2023. We saw an unfavorable impact from year-over-year changes in foreign exchange in our Q1 results, and we expect that headwind to grow in the second quarter. Our Q2 net sales guidance anticipates an unfavorable foreign exchange impact of approximately 60 basis points. As part of our guidance considerations, we also continue to keep an eye on consumer spending and macro-level trends, specifically in Europe, where it appears to be a bit weaker relative to the U.S. Operating income is expected to be between $10 billion and $14 billion in Q2. This estimate includes the impact of our seasonal step-up in stock-based compensation expense, driven by the timing of our annual compensation cycle. I want to thank our customers, our partners, and our teammates around the world for a very strong start to the year, and we're excited to build on this momentum. We'll remain focused on streamlining and prioritizing projects in a way that allows us to continue inventing for customers in a cost-effective way. With that, let's move on to your questions.
At this time, we will now open the call up for questions. We ask each caller to please limit yourself to one question. If you would like to ask a question, please press star one on your telephone keypad. We ask that when you pose your question, you pick up your handsets to provide optimum sound quality. Once again, to initiate a question, please press star, then one on your touch-tone telephone at this time. Please hold while we poll for questions. Thank you. Our first question comes from the line of Doug Anmuth with JP Morgan. Please proceed with your question.
Thanks so much for taking the question. Probably for both Andy and Brian. Historically, Amazon has shifted between periods of heavy investment and then margin expansion and back into heavier investment, but you now have a much bigger base of gross profit and overall operating income. As you think about Gen AI and capital intensity or grocery or Kuiper or healthcare, is there anything from an investment perspective that could materially impact profitability going forward in your view? Thanks.
Hi, Doug. Yeah, we have historically always mentioned that, and you have seen like a pendulum shift sometimes between profitability and investment. I think we're at the stage now where we're doing both at the same time continually. So we are more apt to talk about the specific investments that we're making and how that might impact our short-term outlook. So if you look at the progress we made on operating income and free cash flow over really the last 18 months, a lot of it's driven by improvements in our stores business, lower cost to serve. We've talked about regionalization efforts and how that's moving into inbound areas now. Advertising's been growing strong, and AWS has been strong, and you even saw AWS margins increase 800 basis points sequentially off Q4. A lot of that's driven by cost controls and expanding revenue on the top line and lower cost structure throughout the company. We do see, though, on the CapEx side that we will be meaningfully stepping up our CapEx, and the majority of that will be in our to support AWS infrastructure and specifically generative AI efforts. So I would expect that will increase. It will increase depreciation definitely in that segment. On the when we're talking about CapEx right now, in Q1 we had $14 billion of CapEx. We expect that to be the low quarter for the year. As Andy said earlier, we are seeing strong demand signals from our customers and longer deals and larger commitments, many with generative AI components. So those signals, are giving us confidence in our expansion of capital in this area. And as he also mentioned, we've done this for 18 years. We invest capital and resources up front. We create capacity very carefully for our customers, and then we see the revenue, operating income, and free cash flow benefit for years to come after that with strong returns on invested capital. So a little bit of a long-winded answer to your question, but yes, we have but the main issue that we'll see in the near term is additional CapEx, and we've talked about that. And we continue to see strong CapEx performance in our stores business. Most of that will be related to modest capital or capacity increases, in additions to our same-day fulfillment network and some Amazon logistics upgrades to the fleet. But for the most part, what you'll see is really going to be on the AWS side.
Yeah, I just would add briefly, just to summarize. I understand where the question's coming from, Doug, and I think we're in a position to do both. Is the short answer. I think there's actually an opportunity in our existing large businesses, in the stores business, along with advertising and AWS. There's a lot of growth in front of us, and I think we're investing in a meaningful way. But I think we also, as we've been pretty consistent about, don't believe that we're at the end of what we can do in terms of improving our cost structure on the stores side. I think there are really unbelievable growth opportunities in front of us, and I think what people sometimes forget on the AWS side, it's a $100 billion revenue run rate business that where still 85+% of the global IT spend is on premises. And if you believe that equation is going to flip, which we do, it means we have a lot of growth in front of us, and that's before the generative AI opportunity, which I don't know if any of us have seen a possibility like this in technology in a really long time. For sure since the cloud, perhaps since the internet. And unlike in the cloud, where so much there's a lot of work to be done to move from on-premises to the cloud. People do it and they get value out of it, which is why they modernize their infrastructure. But it's work. All of this generative AI set of workloads, which will transform every experience, are going to be built from scratch on the cloud, largely. And so it's just
tremendous opportunities there, along with some of the other areas that we're investing that are really early stage. So I think it's both for us.
And our next question comes from the line of Ross Sandler with Barclays. Please proceed with your question.
Hey guys, somewhat related question on CapEx intensity in AWS. So I think the CEO of Anthropic has said that I think the next generation of models cost in the neighborhood of $1 billion to train. This would be like Claude 4, I guess, high end, and then the generation after that might be as much as $10 billion to train. So is this something that you feel like the industry will do on top of AWS? Do you feel like Olympus and some of the stuff you're doing in-house needs to kind of stay at the state of the art, or can others do that? And then how much did all this training have an impact on the acceleration that you saw in 1Q for AWS revenue? Thank you.
Well, Ross, I would tell you that we have seen kind of three, I'll call it macro trends that I think are contributing to AWS's performance, at least in the last quarter. I think, first of all, I think the lion's share of cost optimization is behind us. I think companies will be smart and have learned a lot over the last number of months in how they run their infrastructure in the cloud. But I think the lion's share of the cost optimization is behind us. And I think people have moved to newer initiatives that I would, at a macro level, describe as modernizing their infrastructure and then trying to drive value out of generative AI. On the former, I think we were on this march before the pandemic where most companies were trying to figure out how to move from on-premises to the cloud because it's more cost-effective and it's faster to innovate and they get real developer productivity. And then the pandemic hit and people were in survival mode, and then the uncertain economy led people to save costs wherever they could, and they got distracted on that. But they're back to pursuing and figuring it out because it's low-hanging fruit for them, and we see very significant growth in that space. And at the same time, we're seeing very significant momentum in people trying to figure out how to run their generative AI on top of AWS. I mentioned we have a multi-billion-dollar revenue run rate that we see in AI already, and it's still relatively early days. And I think that there's, at a high level, there's a few things that we're seeing that's driving that growth. I think, first of all, there are so many companies that are still building their models, and these range from the largest foundational model builders like Anthropic you mentioned, who every 12 to 18 months are building new models. And those models consume an incredible amount of data with a lot of tokens, and they're significant to actually go train. And a lot of those are being built on top of AWS, and I expect an increasing amount of those to be built on AWS over time because our operational performance and security, and as well as our chips, both what we offer from NVIDIA, but if you take Anthropic as an example, they're training their future models on our custom silicon on Trainium. And so I think we'll have a real opportunity for a lot of those models to run on top of AWS. I think the thing that people sometimes don't realize is that while we're in the stage that so many companies are spending money training models, once you get those models into production, which not that many companies have, but when you think about how many generative AI applications will be out there over time, most will end up being in production when you see the significant run rates. You spend much more in inference than you do in training because you train only periodically, but you're spitting out predictions and inferences all the time. And so we also see quite a few companies that are building their generative AI applications to do inference on top of AWS. And a lot of that has to do with the services. And the primary example we see there is how many companies, tens of thousands of companies already are building on top of Amazon Bedrock, which has the largest selection of large language models around and a set of features that make it so much easier to build a high quality, cost effective, low latency, production grade generative AI application. And so we see both training and inference being really big drivers on top of AWS. And then you layer on top of that the fact that so many companies their models and these generative AI applications are going to have the most sensitive assets and data, and it's going to matter a lot to them what kind of security they get around those applications. And yeah, if you just pay attention to what's been happening over the last year or two, not all the providers have the same track record, and we have a meaningful edge on the AWS side, so that as companies are now getting into the phase of seriously experimenting and then actually deploying these applications to production, people want to run their generative AI on top of AWS.
And the next question comes from the line of Brian Nowak with Morgan Stanley. Please proceed.
Great. Thanks for taking my questions. I have two. The first one is on cost to serve. I appreciate all the color in the shareholder letter and even tonight on cost to serve. Andy, maybe could you just help us quantify a little more how to think about some of your North Star cost to serve goals over the next couple of years, and what could that mean for potential accompanying reasonable ranges of outcomes for North America retail margins through all of that? And then the second one, if cost to serve does improve, I think it should lead to significant incremental cash flow, even with more CapEx. So just remind us again how you sort of think through the philosophy of returning capital to shareholders in addition to continue to invest for the long run. Thanks.
Hey, Brian, this is Brian. I will start with your second question. So as far as dividends or buybacks or any other capital structure moves, we don't have anything to share with you on that today. But I'll reacquaint you with our general philosophy. So our first priority is to invest in to support the growth opportunities and long-term investments within our businesses. And generally, we still have many opportunities to put that capital to use that would generate meaningful returns, especially as you've heard in generative AI. So we have a great deal of passion on that and conviction on that as well. We are reaching a different stage of free cash flow. As you mentioned, we had negative free cash flow for 2 years, 21 and 22, immediately after the pandemic, as we had doubled the size of our operations network and had a lot of other expenses. That was followed by 2023 when we had our highest free cash flow ever. So, and those trends have carried into Q1. So we feel good about the free cash flow. We are, again, still anticipating a higher CapEx this year. The other thing that we're doing with cash flow right now is we're repaying some of the debt that we had taken on during that negative free cash flow period. We had reached a high water mark at the end of Q1 last year. And since then, and then through this year, we'll pay that down over $25 billion. So that's our first priority, as well as 2024 capital expenditures. But otherwise, nothing to share on that front. I'll tee up Andy on the store's profitability, because I know there's always generally the comment about how high can operating margins go and how do they compare to historic trends. And I think the same still holds. We look back to before the pandemic and we say, first, we can achieve those operating margins even without the impact of advertising. And we're not quite there yet, but we're not limiting ourselves to that. We're looking for ways to, again, turn over every rock, look at every process and everything that we do on the logistics side, and see how can we get our cost structure down, and how can we get speed up and selection up. So it's working on a lot of fronts there, but cost is certainly front and center as we meet and improve customer experience.
And the next question comes from the line of Youssef Squali with Truist Securities. Please proceed.
Great. Thank you very much. Andy, on logistics, in September, you launched Amazon Supply Chain. Can you just help us understand the opportunity you see there? Where are you in that journey to build logistics as a service on a global basis? And does that require a step function increase in CapEx? Thank you.
Yeah, thanks for the question, Youssef. I think that it's interesting what's happening with our the business we're building in third-party logistics, and it really kind of in some ways mirrors some of the other businesses we've gotten involved in. AWS being an example of it, even though they're very different businesses. In that we realized that we had our own internal need to build a bunch of these capabilities, and we figured that there were probably others who had those same needs, and we decided to build services out of them. So, as our business has grown, it turns out to be pretty hard work to actually import items from overseas, get them through customs and through the border, and then ship them from that point to various facilities. And then it turns out that you don't want to store those facilities in fulfillment centers because that space is really scarce. So you'd like to have them in upstream storage facilities that are very inexpensive. And then you'd like to have a way to be able to know when your more scarce supply in the fulfillment centers needs replenishment and be able to do it automatically from those upstream storage facilities. And so all of those were capabilities that we had to build for ourselves to be able to operate our stores business in the way that we wanted to and that our sellers wanted to. And so we built that capability for ourselves first, and then we opened up those services as individual services to our sellers. And so we help sellers. We have a service that allows them to get items through the border and through customs. We have a service that allows them to ship from customs to various facilities, whether they're our own or theirs, separate ones. We allow them to store items in our upstream low-cost warehouses that they can either automatically replenish into our fulfillment centers where we ship, or they can move to other facilities that they have. We have a service that lets them, where we'll ship either to our end customers if they're selling on Amazon or to their end customers. We obviously have Buy with Prime, where we enable our Prime customers to be able to buy from our third-party Buy with Prime sellers' websites, which increases their conversion 25% versus what they would do on their own, and it's a great benefit for our Prime customers. And then I would say that supply chain with Amazon is really an abstraction on top of those individual building block services I just mentioned that makes it easier for customers to have the whole end-to-end supply chain integrated. That collective set of businesses is growing very significantly. It's already what I would consider a reasonable sized business, and I think it's just really early days. It is not something that we anticipate being a giant capital expense driver for us. We have to build a lot of those capabilities anyway to handle our stores business, and we think we can, it'll be a modest increase on top of that to accommodate third-party sellers. But our third-party sellers find high value in us being able to manage those components for them versus having to do it themselves, and they save money in the process.
And our next question comes from the line of Justin Post with Bank of America. Please proceed with your question.
Great. I'd like to ask a couple growth drivers that you mentioned. First, grocery. It seems like you're still changing the threshold for free delivery or the subscription prices. Just can you say at all how much that's contributing to your growth right now? And do you think you're over the hump, or are you optimistic this can be a really big category for you? And then maybe a little bit extra on Prime Video ramp, how that ramp went versus your expectations, and do you think that could be a meaningful contributor to ad revenues, going forward? Thank you.
Yeah, I'll take them in opposite order, just on Prime Video ads. Very early days, just launched a few months ago. It's off to a really good start. I think advertisers are excited about being able to expand their ability to advertise with us in video beyond Twitch and Freevee to Prime Video shows and movies. I think they also find that the relevancy and the measurability of that type of advertising in Prime Video ads is unique for them. So it's off to a very good start. It's early days, but we're optimistic there. On grocery, I would tell you that we continue to be optimistic about what we're doing in grocery. We have a very large grocery business. It's kind of got a few different components, and we have a very significant non-perishables grocery business, much the same way that the mass merchandisers entered this business 30 or 40 years ago. These are consumables and canned goods and pet food and healthcare and beauty products. That continues to grow at a very rapid rate. And we have an organic grocery business in Whole Foods Market, which is the pioneer in that space. And that business continues to grow very nicely. We're introducing a new, smaller format in the fall in Manhattan in the Whole Foods Market Daily Shop idea. We've worked very hard on the profitability trajectory over the last 18 months and like the way that that has taken shape. Then if you want to serve as many grocery missions as we aim to serve, you have to have a perishables business and a mass physical presence, and that's what we've been working on with Amazon Fresh. We've launched our V2 format in physical stores over the last few months, primarily in Chicago and Southern California. We like the early results a lot. They're really meaningfully better in almost every dimension. It's still early, and there's some things to work through, but we like what we're seeing there. And and then we'd have to decide the best way to roll those out over time. As you mentioned, Justin, we just launched a Prime benefit for grocery, which is all-you-can-eat delivery for $9.99 a month, which if you order once from Whole Foods a month, it pays for itself, or once from Amazon Fresh for orders under $40, it pays for itself. It's a very valuable offering for our Prime members, and it's off to a great start. So, we have in my opinion, we have lots of ways that we can continue to help customers satisfy their grocery needs, and we have some building blocks that I think might also change how people split up their grocery orders over time. But I continue to be optimistic that that's going to continue to grow for us.
And our final question will come from the line of Ron Josey with Citi. Please proceed with your question.
Great. Thanks for taking the question. Maybe, Andy, I wanted to ask on international profitability just after 1Q's 2.8% margin. Talk to us just about where we are in terms of international getting or to consistent profitability. We're following a similar trajectory as North America in terms of benefiting from regionalization shift, and we saw what average distance of each package traveled actually came down by 25 kilometers and whatnot. And if you could provide any insights on maybe how inbound fulfillment architecture might add to just continued benefits on faster shipping, same day, next day, et cetera. Thank you, Andy.
Hey, Ron, I'm going to start with this one on international profitability. So, yes, in the quarter, our operating income was $902 million. And if you've watched that, we've seen a steady progression in operating income in our international segment. It's up $2.2 billion year over year. So we like the trend there. It breaks down into a few areas. I would say the established countries of Europe, Japan, as well as the UK are following a lot of the same trajectory as in the United States. They are profitable in their own right. They are, adding selection. They're adding new features like grocery. They're adding to their Prime benefits, and a lot of the work that we do in the United States carries over there. The second group is the emerging countries, and of course we've launched 10 new countries in the last 7 years. Each of those has its own particular trajectory on profitability. The first thing we see there is having a good customer experience, having people sign up for Prime. A lot of times our Prime Video benefits help with that. Then work on our cost structure as we get scale, add advertising and other things, and eventually what we see is a break-even. Countries break even, and then they make positive income and free cash flow, and are more of a contribution to the positive contribution to the international segment. So we're seeing both the emerging and the established improving, and we like the trajectory, and I think you'll see more of it as we move forward.
Yeah, I would add a few things. I mean, I'm again quite bullish on our international stores business. It's already a very large business. We've added a number of countries that are on the right trajectory, as Brian just indicated, and it's going to be a big, profitable business for us, and I really like the direction it's headed. I'll take also just the second part of your question, just really around continuing to work on cost structure. I'd say, first of all, on the regionalization side, which we've talked a lot about the last year, it may sound a little boring to talk about because we talked about it a lot of times, but I just tell you that we're not done there. A lot of the work that we've done, we still have opportunities to refine and to get more value out of that. And a lot of what we learned on the regionalization side in the U.S. was in part inspired from what we saw in Europe, which in many ways is set up as a regional network because of the nature of how close those countries are to one another. And I would say we have also learned lessons from what we've done in the U.S. that we're going to be able to apply to our international operations as well. I think we see additional opportunities in all sorts of places. A good example of which is just how and where we inbound items to. The architecture we've had set up has largely had people inbounding to a couple places, and then we took, we spent a lot of effort and time and expense in breaking those down and shipping them to lots of other places. And we believe we can be much more efficient in how we use the inbound network and how we partner with our sellers. Part of what we did with our change in seller fees, we lowered the outbound fees in a meaningful way, but then we added an incentive for our sellers to inbound into locations that allow us to be more cost following and allow both our sellers and us to enjoy in those cost savings when we're able to do so. And we're seeing very optimistic signs there too. I think we're still early with respect to how we can continue to optimize the number of units per box, which has all sorts of good benefits. And then I'd just also say that it's been really interesting to watch the same day facilities evolution in our fulfillment network. And I think a lot of people have made the assumption over the last few years that faster speeds are going to mean higher costs, and that is not the case if you build the infrastructure with the right building blocks the way we have over the last couple of years. And our same day facilities are our least expensive facilities in the network. We still have a fraction of the number of those that we will have in the U.S. and that we'll have in other parts of the world, which will, again, both change our cost structure while increasing speed. So I don't think we're at the limits of what we can do. It's not going to all happen in 1 year. We're going to be working hard at this and inventing at this for several years, but I think we have a lot of upside in front of us.
Thank you for joining us on the call today and for your questions. A replay will be available on our investor relations website for at least 3 months. We appreciate your interest in Amazon and look forward to speaking with you again next quarter.
And ladies and gentlemen, that does conclude today's teleconference. You may disconnect your lines at this time. Thank you for your participation.
All right, folks, that wraps up the conference call from Amazon. So I'm going to go ahead and close out the stream here. We'll talk more about my impressions from that call, and we'll also do a bit of a preview for the Fed and that big day of economic data we have tomorrow. I'll be back on the stream tomorrow on the Traderade Discord to help guide our members through what I expect. And then I'll pop on the public streams a little later in the day to cover the Fed and some of the other events that are happening in the market. So thank you, everyone, for tuning in. Appreciate it, and I'll catch you all soon.